A man in 1920 Chicago signed a single document and lost everything, not because he couldn't pay, but because the contract itself was rigged. Before mortgages existed, homeownership was a luxury reserved for the wealthy. You either had the cash or you didn't own land. But around the medieval period, a peculiar arrangement emerged in England. Lenders created something called a mortgage, literally a death pledge. The borrower would pledge their property as security. If they paid on time, the debt died. If they defaulted, the lender took the house. Simple, brutal. Fast forward to 1930s America. The Great Depression had shattered millions. Banks were foreclosing on homes at a rate that destabilized entire neighborhoods. Here's where it gets interesting. The government didn't abolish mortgages. They restructured them. The Federal Housing Administration, created in 1934, standardized the 30-year mortgage. Suddenly, monthly payments became predictable. Risk was distributed. Homeownership became accessible to the middle class. But there's a detail that museums don't always highlight. This same FHA system explicitly redlined black neighborhoods. Entire districts were marked too risky for lending. The map, this actual map right here, shows the color-coded ratings. Red zones meant no federally backed mortgages. Homeownership, the primary wealth-building tool of the 20th century, was systematically denied based on race. By the 1980s and 1990s, something shifted again. Lenders began packaging mortgages into securities, bundles of debt sold to investors worldwide. A home loan in Ohio could be owned by a fund in London. This abstraction had consequences. Lenders stopped caring whether borrowers could actually repay. They were simply originating loans to sell them off. The incentive structure had inverted. By 2007, subprime mortgages, loans to borrowers with weak credit, had become normalized. Stated income, no documentation, adjustable rates that climbed after 2 years. Lenders knew exactly what they were doing. And when housing prices stopped climbing and rates reset higher, millions of Americans found themselves trapped in homes worth less than their loans. The system that was supposed to build wealth had become a machine for extracting it. Today, mortgages remain the largest debt most people will ever carry. The structure has evolved: digital underwriting, stricter regulations post-2008, but the core tension hasn't changed. You're borrowing against an asset whose value fluctuates, betting that your future income will remain stable. That's not a flaw. That's the design. Understanding that design is the first step toward understanding your own financial story. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how systems like these shape your financial life, subscribe. We unpack the hidden architecture of lending, credit, and debt every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.